The screenshot behind shows me in a short trade on the DAX this morning, and I'm looking for a reward to risk of 2 to 1 plus on this particular trade. I already have my orders set to exit the trade for a loss if the market goes in the wrong direction, and to take profit if the market goes in the direction that I think it's going to go in. So I'm going to talk you through why it's important to look for a reward to risk that's higher than 1 to 1. And primarily that's because it's going to grow your account. And I'm also going to talk you through the reason that I took this trade and show you the outcome of it as well. I'll just talk you a little bit through the chart, what you can see on here, and you'll start getting a feel for what's going on. So my order's already been set, and this is where I entered my short, just here. So about 11 o'clock in the morning I went short here. The market was going up at the time, and I went short as the market was rejecting down this particular spike here. So I went short there. We've got a candlestick chart, the red bars showing bear bars, market going down, green bars showing that the market is going up during that particular time period. So this is the 1 minute chart on the DAX, German stock index, and you can see that I've got an order here. This is the stop for my trade. So if the market were to go up here, or from where it is here, if it were to go up here, then at 12,101 just about, I'd be out of my trade. And the reason that the stop is there is because it's above this high here. 1 spike, 2 spike, 3 spike, 4 rejection spikes there. So if the market was to go up and go past that level, there's a good chance it would carry on upwards, which is why that is a good stop level. So we've then also got to, well, we don't have to, but I have set a profit order, take profit order. So this is a stop order, and it's my protective stop, and this is my limit order to take profits, which is down here. So the trade entry here at 12,091.5 roughly, and the limit order to exit for a profit is down at 12,071. So that's a 2.2 reward to risk that I'm looking for from that trade. If you take into consideration the fees of the trade, it equates to about 2 to 1 reward to risk for the trade itself. And on these particular trades, that's what I'm looking for. Okay, so these orders are already set. I don't have to do anything. I just have to let the market do its thing. So if it comes up, I'd be out for a loss when it reaches this level, and I'd be taking my profit when the market reaches this level. So it's whichever happens first really, or if something in this time period here causes me to think, the market's changing direction and I ought to get out sooner than letting it hit my protective stop, which is what I do. I'm an experienced trader, been trading for quite a long time, so there are all sorts of different trades that I take, but the key for me, for my success and for the success of the traders that I coach and the traders that I train, is that I'll look and I teach traders to look for trading opportunities in the market using technical analysis when there's a good chance that you can achieve a reward to risk of greater than 1 to 1, and hopefully something nearing 2 to 1 reward to risk. And the reason for that is because that is the real way to grow your account. If you keep taking trades where you're getting 1 to 1 reward to risk or less, then it's going to take an awful long time to grow your account, and you need to be extremely accurate. And this is difficult, especially for people who are beginning, people who are not yet profitable, because you make mistakes. And when you make mistakes, then you'll have losses, you'll exit winning trades early, you'll let trades run, and it messes with your account, and it ruins accounts, and it eliminates traders from the game. And I don't want that for any of my students, and it's not going to happen to me. So the reason it's not going to happen to me is because I always look for a reward that's greater than my risk. And it means that when I get a good win rate, my account accumulates cash, and it accumulates cash quickly. And that you know, that's what I want for you, and that's why I make these videos. I don't make them because it makes me feel good. I do it because helping people makes me feel good. Okay, so I want the best for you, and that's why I make these videos, and I hope that you get some good value from them. So my order's already set. I'll talk you through why I took the trade short here. Okay, so most traders, most beginner traders, most less experienced traders, and ones that are not yet completely profitable and consistently profitable, will look for specific signals in the market for them to take trades. And they may look at candlestick patterns, and that's fine, but it does require an extremely good level of accuracy, a high level of concentration, and it also limits the number of trades that you take, because the really good candlestick patterns do not occur all that often. However, if you can understand how the market works, how the market moves, and place trades where there's good value and a high expectation of the market moving, high probability of the market moving in your intended direction, then you're likely to be on the way to success, on the way to profitability and making a living from trading. So what we've got in front of us here, what we've got on the chart here, is a trading range by the looks of it. This is, don't forget, the 1 minute chart, and this is a trading range. On the left here it's started in the middle, on the right it's ending just below the middle, and so there's a slight downward move on this particular chart. You can see down 0.6% based on the information that we've got in front of us. Sorry, 0.06% based on the information that's in front of us, and that's important. But what's more important to me is what's going on in the detail. So here we've got the 90 exponential moving average. This is a long-term exponential moving average, and price is spending more time below it than it is above it, and it's generally moving down. And that's because prices back in the past were falling. Okay, so that's important. When the market's falling, then it'll spend time below the exponential moving averages, and the long-term exponential moving average gives me context. I look at, effectively, when I'm trading, I have a trading time frame, and in this case it's the 1 minute chart, and that's what you're looking at, and I have a master time frame, if you like, which is a higher time frame, and in this case it's the 5 minute chart, and I make my analysis based on both of those charts. Take you through the 5 minute chart for this trade in a second. So we've got a trading range, and so the market's been trading in quite a tight range, to 12,110 down to 12,085. And when the market's trading in a range close to the exponential moving average but below it, and it's already in a longer term downtrend, then my expectation is that it will continue downwards as long as it breaks the lows of the trading range. Okay, so that's one of the rationale for this particular trade. It's in a trading range, it's consolidating, the market's consolidating below the exponential moving average, which you can consider in this case as value. That's a value level. This blue line here is a value level. Every time the market goes above it, it drops below it, goes above it, drops below it, goes above it, drops below it. And in the candlesticks, you can see double tops. At the top here, you've got a green bar going higher, and then a green bar fails to make the highs of this particular bar, the close, and the market goes down. And it goes up, and you've got a good double top at the top here. Market goes up, forms the middle, comes back to the shorter term exponential moving average, goes up, makes a lower high, lower close high, and a lower actual high, and then when it drops below the middle, then you've got a double top, potential double top trade there, and the market comes down and gives you a good reward to risk on that particular trade if you took it. And so that's when, so you can see this is an upward leg. The market is making a low, a high, higher low, higher high. It's starting to go up, but it's just it's creeping up. It's an upward leg, and as soon as it makes a lower high and drops below the middle of those, or drops below the most recent low, that's the middle. Actually, that was the point where it decided I'm off downwards. You can see this big red bar, and the market started heading downwards again, rejecting lower off the 90 exponential moving average, comes down, retests. Do I really want to go lower? Round number 12,100. Do I really want to go lower? Yeah, I do. Look at that big red bar there, and that was the bar that convinced me. So I was on the lookout for a short trade as soon as I saw that big red bar come in there. Wasn't already short. I'll let the market come down, move back up, and I'm looking for, what tells me the market could go down further. Well, I've got a rejection spike there, there, and there, and I entered short here. And you might think, well, the market was going up. It had made a low, higher low. Is it going to go up? Well, that's why my stop was up here, because if it had gone above this level here, then it could well have careered a lot higher. But as you can see, at the moment it's rejecting below this is the 20 exponential moving average, the red line, the blue line's the 8 exponential moving average. So 3 different moving averages on here, and I went short just as it was rejecting south or lower than the 20 exponential moving average. I went short there, and we had an inside bar, we had another inside bar inside this big mother bar here, inside, and so that again is minor, very small. These are 1 minute candlesticks, but that's a pause bar, that's consolidation, and when the market broke the low of there, it started going down, the low of these 2 bars here, the market started going down. And as we have a look at the trade here, I'm feeling confident that the market is going to make its target, okay, which is here. So that's my order, which is already set. So I could go and have a kip if I wanted one, but I didn't, and I generally don't, because these trades don't tend to last too long. This is the 1 minute chart, and so, and also, if the market started making higher highs, higher lows, then I might want to take profit early, or I might want to get out for a smaller loss than it hitting my stop. I would say probably 70% of the time I'd let these orders fill automatically, however. And in order for the market to make the profit target, it has to get past these lows here. It has to get past these lows here. So this is an important time that I took this screenshot, and we'll wait and see how the market went on from there. And you can see, just moving it on slightly further, it did break the lows, the most recent lows, and I'm feeling confident at this particular stage. So you can see the risk to reward here is, the risk is 1, the reward is 2.2, so it's 2.2 to 1 reward to risk. My stop order is here and my limit order is down here at 12,071. Okay, so this is looking good now. We've got a high, well, the low, there's a low here, so a lower low, lower high. So we've got a lower low, lower high, and so that's indicating a downtrend. And so the market comes up here, tries to consolidate at that level there, but it's below the 12,100 level and it's above these short-term exponential moving averages, but there's a gap there and there are spikes on the top, which tells you that the market's probably going to go down from there, and it did. Big jump downwards, and so there you go, that's where I entered, and we are now staying below the 20 exponential moving average and below the 8 exponential moving average. We've had a bear breakout here as it went below the most recent lows, and there's a bit of a spike on this particular bar here, but I'm expecting to reach target. So my hands are just resting at this point in time, not hovering over the exit. You know, I could close this trade if I wanted to here, and you know, we're at more than 1-to-1 reward to risk. This is where the market's at. That's the risk there. So we're at more than 1-to-1, but you know, experience tells me, and the way that I understand the markets tells me that there's a good probability that this particular trade is going to work out and I should hang on there. So I'm even prepared for the market to come up here and do what it needs to do up here, still stay in the trade, and if it goes up to this level here and takes me out for a loss, then it does that. But I know that, you know, when I entered the trade, I knew this trade had something like an 80% chance of winning, and therefore I'm prepared to take the risk. You know, with an 80% chance of winning and a 2-to-1 reward to risk, you're gonna you know, as long as you only take those trades, you're gonna start making lots of cash. And that's what we do this for, isn't it? This is what we're in it for. We trade for a living, and that's you know, that's what it is. So we stay in the trade and we move onwards, and this is what happened. So you can see that this is the 5-minute chart here, this is the 1-minute chart. I entered my trade on this bar here on the 5-minute chart. I entered my trade here. You can see that all morning pretty much, this is 7 o'clock when the market opens, the market started falling and it's continuing to fall. It's had a slight rebound, but when this happens, when it's down all morning and then it just rebounds, it doesn't mean it's going up. It means that it's giving traders who've taken profits here and are still thinking the market's going down, which is the majority of traders, it gives them an opportunity to get back in again and bet that the market's going to fall further, which is what you can see that it did. And you can see that I'm no longer in a trade, and the reason that I'm no longer in a trade is because my limit order has been hit and the software has taken my profits for me. So that was a winning trade. And some interesting stuff that you can see on here is that, let me just bring a bar in here. So you can see one of the reasons for entering where I did was that this trend line here had been pierced. So you can see that was a slight upward leg in a downtrend. You know, I did enter trades in the double tops up here, and already taken profits on those. But in the bigger picture, what was happening was the market was forcing its way down, and in downtrends there are up legs, and this was an up leg, very haphazard. Always think which is stronger, 1, 2, 3, 4 red bars on the trot, or that higgledy-piggledy up and down. Higgledy-piggledy up and down. That's not a technical phrase, that's just me. And so this is stronger. And when you've got price action in a similar range, one of which, the downward pressure is stronger than the upward pressure. When one's stronger than the other, you can bet that the traders are waiting for an opportunity up here to go short. And when the market comes back up again, and then for me, when it presses down below the exponential moving averages and breaks this trend line, then it's a good trading opportunity to go short, and that's what happened. And fortunately for me, the market hadn't pressed up too high here, and it had left me with a good place to put my protective stop, which was above here, and know that I could safely say that if it went above this level here, if this had started going up like this and went above that level there, then it was probably going to be, the fight back from the bulls was probably going to be slightly stronger. I think it probably would still have gone down again, but I wasn't prepared to go past the risk on that particular one of what I was looking at. It could have carried on back and gone all the way back up here. It does sometimes, and so that was, but that wasn't my trade. My trades are to take a fairly small amount of risk, and I very, very rarely take a risk of anything more than 25 points on the DAX, and more often than not I'm looking at sort of 10 to 15 points risk. And this was an opportunity that fit my, it was just less than, it was about 10 points, wasn't it, the risk. And I adjust my position size according to the level of, the points risk. So it doesn't mean that I'm risking more money, but it means that, the way that this market moves, I'm pretty confident that it moves in a way where if there are breakouts, then I can get 2-to-1 reward to risk with a 10-15 point risk. So I know that it moves, and it moves in up and downward spurts of 20 to 30 points, and when there's a breakout you can quite often see 20 to 30 points within a few bars, and that's what we got here. So actually I think we've got about 15 bars before the 17 bars there before the profit target was actually met, and that's 15-17 minutes. That's about right for a 2-to-1 reward to risk trade, and very often you can actually find that you get your 2-to-1 reward to risk within 2 to 3 bars. Sometimes it takes a little bit longer. It did this time, but you can see the market's making low, high, lower low. As the market crossed this level here, that was a lower low. There's lower highs coming in here, 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 and it was only a question of time before the bears won. And on this particular occasion, the bears won. Doesn't mean the market's going to go down forever, because it won't, because the bears will start taking profits as I did around here, and it'll mean that the bulls are able to fight back somewhat before the market starts going down again. And it's not until the bull fight back is stronger than the most recent bear leg that I'll start considering long trades. And so that's an insight into how I work, how you can grow a small account, how you can grow a big account with good risk, reward and probability trades. So, hope you found that useful. My name's Anthony Beardsall. Thanks ever so much for joining me, and I'll look forward to speaking with you again on the next video. Bye for now.